Hey folks, welcome back. It's Money in Politics on October 4, and thanks for joining me again. I'm going to be talking about a number of things that have been going on today. Kind of a weird day on Wall Street. And I'm sure a lot of you know that one of the weird stories is that Facebook went off the air for whatever reasons. I don't know if that's an attack. I don't know that they know. It might have been self-imposed problem, but they went down almost 17 points at the close. They're up slightly in after hours. You can see the price, $326. Facebook, I think, is one of those things. I don't own it. I have owned it, and I did own it for a long time. I got in at $112. I actually first bought it at $25 and got out of it and got back in at $112. And I got out a while back. I'm not sure, trying to remember why. I didn't expect it to go to $300. One thing I would say is that obviously, increasingly, social media, we talk about money in politics, social media is going to be the recipient, I think, increasingly of dollars coming from campaign funds. And as we go into 2022, that will be one of the reasons that could drive the price up of Facebook as they get more money coming in. They have been doing well on the revenue front. Their profits sometimes bounce. You can see they've beat here the dots, the green dots have been beating expectations. You can see the revenue growth there in the green, where they are currently, at least in 2020, did over $85 billion with earnings, profits of $29 billion. And you know, it's certainly not a penny stock, and I know a lot of people in Humble Land are fans of low price stock. But that's not. I'm not telling you to buy Facebook, but I do think it's probably something that you're going to be safe to buy. I think I might see where it goes from here. Let's see how long. Last time I checked, Facebook was still down. In fact, for a while, I thought I got blocked, and then I saw news reports that it was down. Okay, so here's Humble, and you can see this is a one-day chart, and it's kind of surprising we had this spike up to 80 cents there in the middle. What this is telling me, first of all, one day you can't draw too much, but we have been, as I said, in this trading range from roughly 79 cents to a buck for a while. Right now, you can see here we were at $1 something just about a month ago. And I think, of course, we've talked almost every day over the last 9 months, 10 months about Humble. I'm still a bull. I think a lot of the people who are critics are not critics for valid reasons. They're just FUD speakers, as we say. And their criticism isn't legitimate because they don't have any legitimate arguments. Sometimes I get some good questions. Sometimes I know the answer to the question. Sometimes I don't. But, you know, a lot of these people blah, blah, blah. Well, a lot of these people just, I think, are just shorting, and they like to go online and condemn Humble. But Humble has been on a roll as far as getting things done. You go down here, they just added a new independent director, which is the second one, and that's a good. Humble announces the launch of Humble Tickets platform. Humble announces the launch of the NFT gallery and client services. And when was that? Oh, only 27 days ago. Last month, Humble Ticket announced a syndication partnership with Ticket Evolution. So what I'm saying, folks, is you look at the performance, not necessarily right now of the stock, but of what they're doing. This reminds me when I was in my teen years and I'd go bowling. My dad was a bowler, and I'd go bowling with him. And every time after I threw the ball down the lane, I'd run back to see what the score was. And I remember my dad saying to me, just pay attention to what you're doing and the score will take care of itself. And I think that's the story here with Humble. They are performing and they're getting things done. And I think they're going to, as I predicted, by the way, back in June, that the second half of the year is going to be where we're looking at execution. So that's that. So we talked on Facebook, we talked on Humble. Nothing new that I could add to it right at the moment. The other thing is InMode, which just did its split, and of course it spiked up. So let's look at the, and by the way, this chart on Yahoo Finance here has not been adjusted for the split, the 2-for-1. You see that the price shot up to about 175. Now that price was the pre-split price. And then it shows it going down like by 50%. Well, it did go down from 175, but if we adjusted the price here as a 2-for-1 split, that would be close to 140. So the price isn't down really from 175 to 68. It's down, you might say, from 175 to 140, down $10 today. Why is it down $10 today? It's down $10 a day just because, see that spike right here where it went up, and let me see if I can make that a little easier to see. You see we had a nice evolution of the price here going up, nice, smooth, as I say, like an airplane taking off. And then because they announced the split coming up, between the 13th here and the 20th, we had this really high spike going up. That's why that was not sustainable, that last part. What I expect is going to happen is we're going to come back down to a trajectory that we have been on throughout the year. And let's go to a one-year chart. So you can see how that spike, and again, that was entirely driven by the announcement of the 2-for-1 split, but otherwise we had a nice sustainable trajectory upward. And that is what I think is something that you want to look for. That is a sustainable spike as compared to, what is the term I'm looking for here that I can't think of? Parabolic growth. Now, as we go down, I need to adjust this. Okay. The other thing is a reminder that we look at the green lines, look at the revenue growth, look at the blue lines, the profits. This is going to keep going on for, I think, 3 to 5 years. So to me, folks, I would say, in my estimation, InMode remains a buy. It got a little ahead of itself. You could, if you don't have any yet, you run the risk by not having any. You certainly could, if you buy a small amount of shares, depending upon what that means to your portfolio, whether it's 200 shares as a small amount or 2 shares as a small amount. Buy some, it could go down from here. Because we had the run-up. But again, we already came down from about 175 to 140. I'm little more than 140. And where was it? Right at 136. So we're about in the area of where we were now right before the spike up because of the coming stock split. By the way, if you look at that spike and look at the volume spike here down at the bottom, when you get an announcement like that of a 2-for-1 split or a 10-for-1 split, you're going to get people coming in and driving that up. That's something you're going to get. If you want to make some short-term profits, you could buy something that where the split's coming, but then you might want to get out before the split. Are stocks always going to go down after the split? No, they're not. We had TTD that I've talked about before, Tom David, and that went up or split 10 for 1. After the split, it was $63. I bought some at 63, and then it ran up into the mid 70s. I don't have the current price of it right now in front of me. Another stock I have, you might remember I interviewed the CEO, Mr. Sandgaard of Xynx just recently. And that is down. And you can see it's they're adding, as they said in the interview, that they're adding a lot of salespeople and they're anticipating growth of revenue. And you can see, let me get myself out of the way, that the last 2 quarters have beat expectations. You can see the jump in their revenues, and their revenues now for 2020, $80 million. Their profits were flat, same as about last year, but both cases roughly in the area of $9 million. But Mr. Sandgaard told me in the interview that that was because they incurred a lot more labor costs putting on some of the people who are doing the sales, the big sales force, and that it takes a while, is understandable, for a salesman to go out and start being productive. So Xynx, which has devices that kind of put the kibosh on pain if you've been in a car accident or sometimes after surgery. This is like a device about the size of a cell phone that can be attached to you, and it helps block the pain messages going to your brain. So it's a way of fighting pain without being on drugs. And the risk that has, because obviously people can have negative reactions to pharmaceuticals. It is now near its 52-week low. So today I just wanted to give you kind of an update on some of these things, because in the past, and I think it was here at the end of June, that's February, but here in the end of June, it was about $17. So if it went back to about $17 from the current price, you'd be up about 70%, 70. You can see in the lower down here, fair value, first column at the bottom, you can see that they say it's right about the mid-range from fair value rather. And so I think this has, my estimation, my educated guess is that Xynx at this point has more upside than downside. And as I said, we're at a 52-week low. So we got InMode, we got Humble, we talked about Facebook, and the other thing I would bring up is, again, as the Fed has said, they are going to be raising interest rates. Let me do this full screen here for a sec. They're going to be raising interest rates probably about 6 times over the next 2 years. That's an approximation, but that's probably about right. And so we are going to, by the way, let me throw this in real quick, because I think I forgot to bring this up. Let me take that down. There we go. As a reminder, I'm someone who's been an investor for a while, but I'm not a registered broker or financial advisor. So you decide things at your own risk, okay? Now that said, when interest rates go up, existing bond prices go down. If they raise interest rates, the Fed, to let's say 3%, and you have a bond that's paying 1% interest, when the Fed puts out a new bond, the new bond might pay 3%. Let's just say, I want you to just get the concept. So if you have a 1% bond that you've had for maybe 5 years, no one is going to want to buy your bond if you go to sell your 1% bond that's paying 1% when they can go out and buy a new bond from the Treasury Department that pays 3%. And so if you want to sell your 1% bond, you're going to have to cut your price. So that being said, that's why bond prices go down on existing bonds as interest rates go up. I spoke about this in the past, and this is, I keep hitting the wrong button there. This is TTT, TTT. And the thing is, this is a way of shorting those bonds that are going to go down in value. And so as we have the expectation of interest rates going up, we can see that this now is at $34. Is this a surefire deal? No, but it's a way of buying a trend. I think this will go up. When I spoke about it last time, I think it was actually at about $42 or so. So I probably spoke about it here as a longer term deal. It depends. I just want you at this point, folks, you don't feel like you got to rush out and buy this, but TTT ProShares ultra short on the 20-year Treasury. So I just want you to be aware that those are going to fall in price as interest rates go up. So as we start to see interest rates go up, or if you want to take a position in that now, that could certainly swing upwards. If it went from where it is today at about $34 and it went up to where it was back in the May or so, you'd be up about $10 or about 30%. Over the last year, back in March, that was about $46. So that would be a 12-point move. Again, a little bit more than 30 something percent. So we covered a lot today. I wanted to say again, if you haven't subscribed, we're going to be covering, the game is changing, as I said, on the landscape of investing. It's not going to be the same, and we're investing in the low interest market, just as we've seen home prices go up because interest rates went down, and that meant that people could afford to pay more for a house, more in terms of the sale price, because the lower interest rates kept the monthly payments low. Now we're going to get the reverse. So you might actually see, frankly, home prices, resale prices of existing homes go down if interest rates go up markedly. Now, my expectation is that over the next 2 years, interest rates will go up, but I think that they're going to go up at a slow pace. Again, I'm expecting the Fed, when they increase, that it will roughly be at about 0.25% each time. I don't think they want to spook the market overall. I think they want to do it on a cautious way and just kind of ease in to that. If you want to get updates on Twitter, I don't Twitter or do out tweets every day. Sometimes I do more than one. And when it's something where there's some news that's kind of I use Twitter more as kind of hey, this is happening, and kind of send out a quick flash. That's my Twitter handle if you want to follow me there. And as always, again, if you want to be sending me an email, you can go to moneyandpoliticsnow@gmail.com. So we've run the gamut. I think that's pretty much for today. As always, folks, I appreciate it. Hope you had a great weekend. We're going to be keeping an eye on the markets and other policies. And we'll have to keep an eye on what happens with the debt ceiling. That's been a conversation, one of the big conversations today. It will remain so. The Treasury Department is going to run out of the ability to pay bills around October 15. It's not an exact date, but somewhere in that neck of the woods. Okay, so we'll have to keep an eye. That could have a big impact on the markets. We'll have to see how it gets resolved. Right now, the Democrats and Republicans are playing a game of chicken. And so this is where we say money in politics, because this is the politics right now on Capitol Hill. And you might expect some real down days on the market, potentially. I'm not saying for sure that's going to happen, but you could expect some really down days on the market. I mean, today the NASDAQ was down 2%, 311 points. The Dow was down 323, and the S&P. So both the S&P was over about a point, 1.3% on the S&P, close to 1% down on the Dow, the NASDAQ 2%. I should also say, by the way, speaking of that, I've often said I love the TQQ, but the TQQ is great in an environment where the markets are going up. The TQQ is going to go down 3 times faster, as well as go up 3 times faster. So when you have an environment like this where you could be going down, you got to be, maybe getting out, going to the sidelines. So I wanted to bring that to your attention. You can see that the TQQ fell sharply today, 6%, closing at 119. I mentioned, I'd have to go back when it was, it might have been a week ago. I took some money off the table when it was at 137. And that was not that long ago. You can see this is on the end of August at 150. And then we've been coming down. So I have not sold all the way out of TQQ, but I did take some money off the table at 137. If I knew it was going to come down that much, I would have taken maybe all of my position off. But we don't know these things. That's why you don't want to sell everything at one time. You don't want to buy everything at one time. That's a way that we can control what we know as the market change. So just be aware of that. These could go down. If we do get a good sell-off, if we get a sharp decline, and everyone's going, oh my God, the bull market's over, we're going into a bear market, we're going into a recession, typically that's a good time to buy these leveraged indexes. I took some money off because I think we had hit kind of a top. All right, every day I go further than I wanted to go, longer than I wanted to go. But folks, thanks so much for joining me. Don't forget, sign up, stay in touch, because as we go further into the Biden administration, we're going to have a lot more tug of wars on Capitol Hill, and I think it'll be important for you to be able to listen to me as I've covered Wall Street at both the congressional level and locally in Illinois. And you want to have someone who's financially literate to kind of make sense of this stuff. Thanks so much. Leave your comments, leave your questions, and we'll see you next time.